All right. So we are going to be having today is going to be the fourth lecture day on business valuation. Um, let's see where we are going to end today's class. Hopefully, we'll be able to complete the outstanding questions. Now, so far, we have tested a question under valuation on using asset-based approach. We solve another question, the same question that involve price earning ratio method. Then we also tested dividend yield, okay, discounted dividend model method. Then thereafter, we move to solving a question that involve stock exchange listing. A company is going public for IPO, how to value a company going for initial public offering, right? Then we solve another question that involve whereby this one has to do with merger and acquisition, uh, whereby a company is acquiring interest in another company. Uh, in this case, in the question, business and financial risk uh, changed. So as a result of that, we discount the free cash flow using the uh, work of the combined businesses. Then the fourth question that we solved was a situation whereby a company is acquiring interest in another company, but this has to do with a takeover, that is acquisition. The company acquire one of two shares in BOPLC. All right. I think that was where we stopped. So today we are going to look at another scenario under valuation, whereby um, I think have we solved the question where business risk does not change but financial risk changes? Did we? I doubt. I think EP was the last question we tested, right? Let me see if okay. In any case, when I begin solve, you can tell me if we have solved it before. All right. So let's say we have two more under the scenario. Like I mentioned to you, when you are valuing a business um, through business combination, either merger or acquisition, I told you specifically that there are three different scenarios that may arise. Those scenarios are meant for merger and acquisition, not for any other thing. All right. So during merger, when there are merger and acquisition transactions, so those three scenarios could arise. The first scenario is a situation whereby business and financial risk will change. And we said that when that happens, the free cash flow should be discounted using the work of the combined businesses. The second scenario will arise where business risk will not change, but financial risk will change as a result of the business combination. And we said that when that happens, the valuation should be done using the adjusted present value. All right. Then the last one is a situation whereby business and financial risk will not change. And we said if that happens, then the free cash flow should be discounted using the existing work of the combined business, using the current work of the combined businesses. So that's what we need to do. So far, we have tested the first scenario whereby business and financial risk change. So let's test the other one whereby the second scenario whereby business risk will not change, but financial risk will change. All right. So let's have an illustration. ICAN has not tested this second scenario whereby business risk will not change, but financial risk will change. All right. Uh, but you never can tell. You don't know what is coming in the November exam. But in any case, let's have a look at that example. Yes, let's have illustration number 4. Okay, let's test illustration number 4. Let me read this for you. Let me read this for you. The directors of Arsenal PLC are considering the acquisition of Lacazette Limited, an unquoted company. The shareholders of Lacazette Limited are willing to sell the business on 1st January 2011 for 500 million naira. So that 500 million is the purchase consideration. From the perspective of the directors of Arsenal PLC, the projection of the performance of Lacazette Limited are shown below. All right, we are given the current year cash flow. We're also given projection during the planning horizons in years. The assumed company tax rate is 35%, okay, per annum. The terminal value of the investment is treated as a constant perpetuity equal to the free cash flow for the year 2016. Terminal value is the value after the initial period. The initial period is the period whereby the evaluation will cover. Then after the initial period, you need to determine the value of the business to perpetuity. So the value to perpetuity can be said to be the terminal value. Okay. So the risk-free rate of interest is assumed to be 6% per annum. All right. That's the risk-free rate of return, RF. The return on market portfolio is taken to be 13.5%. Okay, this is our RM. Why is an asset beta of 1.1? Okay, we are given asset beta of 1.1. All right. Is used for the purpose of the evaluation. All right, let's move on. Annual capital expenditure from 2010 onward is estimated at 20 million naira each indefinitely. All right, so that's capital expenditure. Additional non-current assets to be 20 million. Lacazette Limited currently has on issue 400 million naira of debts, 400 million naira of 8% debts, and it is intended that all available cash flow should be applied to repaying this debt at the earliest opportunity. All right, so there's a debt to be paid of 400 million required. Advise the directors of Arsenal PLC whether to proceed with the acquisition. That is the requirement. Examiner is asking you to advise whether the directors of Arsenal PLC should proceed with the acquisition. Bear in mind that the directors of Arsenal PLC will only proceed with the acquisition if it will result in additional equity value being created. If additional equity value is being created, then they can proceed with the acquisition of Lacazette Limited. So that is the question. That is the question. Then what are you supposed to do? How do you value this? How do you value um, how do you value Lacazette limit, or how do you value this business combination? All right. How do you value the business combination? Under this scenario, the first thing first you need to do, all right, is to identify the kind of scenario you have here. Is it scenario 1, scenario 2, or scenario 3? We said scenario 1 will occur where business and financial risk will change. Scenario 2, only business risk only business rule will not change, but financial risk will change. Scenario 3, business and financial risk will not change. So now, and I explained to you when I was giving you the concept, and I said that business risk will change if the two combined businesses are not in the same industry. That's one indication. If you can find an indication in the question where it is mentioned that the two businesses are in different industry, it means that business risk is going to change. Remember, business risk is the risk associated with the industry where a company operates, and business risk is measured by asset beta. Now, and I told you the second indication you can find in a question to know whether business rate will change is if in the question you are given different asset beta. Once you are given different asset beta, it means that business risk is going to change. But if the two companies have the same asset beta, it means that business risk will not change. So for business trade. The other part is financial risk. We said that financial risk is the risk arising from debt financing, and under valuation, financial risk will change if the business valuation or if the business combination will resort to additional debt being paid. That's one indication. If you can find any indication in the question that a debt will be paid, all right, so in that case, it means that financial risk will change. But if you don't find anywhere in the question that is mentioned that a debt will be paid, then if you are given a different debt equity proportion after the business combination, if you are given a gearing ratio after the business combination, it means that financial risk will change. So these are the way you can identify from the question if business and financial risk are going to change or not. All right. So in this particular question of Arsenal PLC, let us see in the first paragraph whether examiner mentioned that. So in this first paragraph, you are told that the directors of Arsenal PLC are considering the acquisition of Lacassette Limited, an unquoted company. The directors of Lacassette Limited are willing to sell the business on that date for that amount. From the perspective of directors of Arsenal PLC to projection. So in this first paragraph, there is no indication to know whether they are in the same industry or not. Examiner did not tell us. So in that case, since there is no clear indication, I need to look for another way of identifying from the question if uh, uh, business rates will change. So when I was reading it, I saw asset beta and I noted it down. This is asset beta. So we are told that whilst an asset beta of 1.1 is used for the purpose of the evaluation. So we have been given only one asset beta. So this shows that the two, both Arsenal PLC and Lacassette Limited, they are in the same industry. Since we are given the same asset beta, it means that they are in the same industry. So if the two businesses are in the same industry, it means that business risk will not change because they're in the same industry. We are not going to be exposed to business risk. Then the next one is to now go back again to the question and find out if financial risk will change. And I said that financial risk will change if there will be additional debt to be paid, if there is a debt to be paid, or if the debt equity proportion, the gearing ratio after the business combination is going to change. So in this question, examiner has told us that Lacassette Limited currently has unusual 400 million naira of 8% debt, okay? And it is intended that all available cash flow should be applied to repaying this debt at the earliest opportunity. So we want to pay 400 million naira debt, which means that the business will be exposed to financial risk after the acquisition of Lacassette Limited because this 400 million naira must be paid at the earliest opportunity available. So if that is the case, in this question, business risk will not change because both Arsenal PLC and Lacassette Limited, they are in the same industry because of the asset beta of 1.1 given to us. Then financial risk will change because after the business combination, Arsenal PLC will need to pay a debt of 400 million naira at 8% interest at the earliest opportunity available. So if that is the case, business risk will not change, financial risk will change. As a result of that, we are supposed to carry out the valuation using the adjusted present value. So we are going to use APV to value the business combination. All right. Using APV for valuation, what are the steps? There are three key steps you are going to carry out when you are calculating APV. The first step is to calculate the base case NPV. All right. You calculate base case NPV. Then step two, you calculate present value of financing effect cash flow. Then step three, you calculate APV. APV represents the corporate value. Corporate value is the enterprise value or total value of the arising from the business combination. Therefore, to now get the equity value, we are supposed to less debt value from the corporate value. Whatever you have thereafter will then be the equity value. So once you calculate that equity value, then that is the additional equity value created. So you can then advise the directors of Arsenal PSC whether they should proceed with the acquisition or not. All right. So that's what we need to do. You know already how to calculate base case NPV, how to calculate present value of financing effect. To calculate the base case NPV, what do? This is valuation. You go ahead and calculate free cash flow. You calculate free cash flow. After that, you are going to discount the free cash flow using cost of equity long geared. All right. Then you have your present value. You have present value for the initial period. In this question, initial period will be from 2011 to 2006, 2011 to 2016. Current year is not part of it. You have to ignore the current year cash flow. Cash flow must relate to the future. All right. So the future cash flows are from 2011 up to 2016. So this represents the initial stage. We are going to calculate present value for the initial period, which is for 6 years. Then from 2017 to infinity, that will be the terminal value. Okay, that will be the terminal value. We need to calculate present value from the initial period to infinity. That represents terminal value. All right. So once you calculate the present value for the initial period, you also calculate present value for the initial period. For present value from after initial period to infinity, you add the two together, you get the total present value. Okay, you get the total present value, then you less purchase consideration. That is, in this case, the purchase consideration is the amount you are buying is the amount Arsenal PLC is paying for acquiring Lacazette Limited, which is 500 million. All right. So you then have your base case NPV. You keep it on one side. You then go ahead and calculate present value of financing effect. You go to the question and check. Are you given issue cost? Do you have subsidized loan? Okay. So if you don't have issue cost, you also don't have subsidized loan. But if you can see anything like interest expense, then in that case, like in this case now, we have interest charges. Okay. That means we need to calculate tax saved on interest. We need to calculate tax saved on interest. So that means only tax saved on interest will be the PV of financing effect. Therefore, if it is possible, if the PV of financing effect is positive, you then add it to the base case NPV. That will give you the APV, because APV is base case NPV plus minus present value of financing effect cash flow. So you add the two together, then you have your APV, which represent the corporate value. You then less the debt value. Debt you want to pay is 400 million naira as given in the question. From the APV, you pay debt of 400 million. Once you pay the debt of 400 million, then the balance will then be for equity. All right. So that's what you need to do. That's what we are going to do. Quickly, let's stop sharing this and move to the working note straight. All right. Okay. Let me see from the question which solution. This is question number what? Question number 4. Illustration page 83. Page 83. Illustration 4. Illustration 4. Page 83. So solution. Asana PLC. Okay. So the first thing that we're going to do, from my explanation, we have identified from the question that business risk will not change, but financial risk will change as a result of the business combination. So we are using adjusted present value to value the business combination. So in this case, we are going to first of all calculate base case NPV. All right. So step one, I would then say calculating base case NPV. Our figures are in million. All right. So this will be for the next 6 years from 2011 to 2016. All right. So, when you are discounting, you can't be using number of years. You can't be saying 2011, 2012, 20. So you have to represent it per year. So this would be for year one, year two, three, 4, 5, and then year 6. So to now calculate, I will go back to the question. How am I going to calculate my free cash flow? The first thing you are going to do when you are calculating base case NPV is to compute the free cash flow. After you have computed free cash flow, then you now calculate cost of equity on geared. So according to the question, what are the cash flow given to us? All right. So in the question, you are given our financial projection. All right. From 2011 up to 2016, I've told you, you need to ignore the current year. We don't need that one. Cash flow must relate to the future. Therefore, in the question, you are given profit before interest and tax. So you can start from profit before interest and tax. So let's round our number. For the 2011, the first year is 97. That is 96.7. So that gives us 97 rounding. So profit before interest and tax, 97. What is the second year? Uju, you are going to be my partner on this question. So you will supply me the numbers.
Okay, sir.
All right. So the second year cash flow will then be 118.6. That's 119. So you give me the next one. Here is 119.
118.6.
Next one. After 119, which one is next?
I didn't get it.
Pardon?
143.
143. Next one.
170.
170, sorry. 200.
Okay. You're 6.
200.
All right then. So now that we
200.
have the profit before interest and tax, remember we have a format for calculating free cash flow, right? This is free cash flow to the firm. So now that we have the profit before interest and tax, the next thing we are going to do, remember, when you are calculating free cash flow to the firm, anything that has to do with suppliers of capital, you ignore it, like interest, like dividend, so you ignore it, loan repayment, all right, proceed from debt issue, all those things, you ignore it, all right? So immediately after the profit before interest and tax, you need to pay tax. So you then call me a tax. According to the question, what's the tax rate?
That's 5%.
Tax is 35%. So you are going to multiply 35% on profit before interest and tax. So what do you have for year one?
34.
34. The second one,
42.
42.
42. Year three,
50.
50.
60.
60.
70. 70.
70. 70. So that is for that. The next thing we are going to do after tax, you are supposed to consider there's no need for you to find the difference to get profits after tax. Just ignore. The next thing we are going to do is to add back non-cash item. We then go back to the question to identify if we are given anything like depreciation, non-cash item. All right. So yes, in the question we have depreciation and amortization. So 42 for the first year. So you had it back. So I would then call my depreciation. and amortization. 42 added back. Then year 2, 44,
44.
right? Next,
46.
next,
48.
next,
50.
50, and then 52. So again, I will then go back to the question to confirm. In case I'm given working capital, all right? If I have anything like working capital, then I need to consider that. So in the question, we don't have working capital. So that means changes in working capital will not arise. So I need to go back to the question again in case I have anything like capital expenditure. Yes, in the question, examiner told us that there will be a capital expenditure, annual capital expenditure from 2010 onwards is estimated at 20 million naira each indefinitely. So there is capital expenditure of 20 million. So it's a constant amount. So I would then call a capital expenditure 20 million for year 1 all through the same amount. At times, examiner will tell you that this capital expenditure will grow with a specific percentage, but in this one, it is constant since you are not given the growth rate. So since the capital expenditure, based on the formats, capital expenditure is the last one when you are calculating the free cash flow to the firm. So at this point, we need to get the difference. Give it to me. What's the difference in year 1?
85.
85,
101.
101,
119.
next.
119.
I didn't get that. 119.
119.
Okay.
138.
138.
160. 162.
This should be year 5 and
160.
6.
160.
160. Then this one will
160.
be one. Okay. This will be 162 then. All
Yeah.
right. So now that we have the free cash flow to the firm, I think somebody sent a message. Let me check. From Ufama, sir, I thought we had depreciation before charging tax. Is that the format I gave to you, Ufama? Go back to your notes. You don't charge depreciation before tax. That's not the format I gave to you. So now, Victor, are you the one disrupting my class? Please mute. Please mute. Now, the next thing we want to do is to now discount this free cash flow using cost of equity long geared. Therefore, I will then come here. Remember we are using APV. So we are calculating base case NPV. So we need to go and calculate cost of equity on geared. So I will then go to the question, how am I going to calculate my cost of equity on gear? Am I given beta? Am I given cost of equity? Am I given WACC? So any of the three that I'm given is what I'm going to use to calculate my cost of equity on gear. So let's start from this side. Let's start from here. I want to calculate cost of equity. Let me see if that first page will be sufficient. All right. This should be sufficient. So I will then go to the next page to go and do working for cost of equity on geared. All right. So calculating cost of equity on geared. So in the question, the examiner has given us a beta, asset beta of 1.1. That means we are going to, since we are given asset beta is an ungeared beta. So all we need to do is to just to calculate capital asset pricing model using the beta, and that's what we need to do. Remember, when you are calculating adjusted present value from your base case NPV, you don't regear your asset beta, because once you regear, that means you are putting the financial risk. So you only want to calculate the business, so that's why you don't regear. So in this case, I will then come here. I can say since asset beta of 1.1 is given, okay, the KEU, cost of equity long gear, will be calculated as follows. If this beta is a gear beta, we need to ungear. Once you ungear, then you calculate the capital asset pricing model. Remember, in the normal APV, we said that if beta of a proxy is given, there are 3 steps. The first step is to identify the proxy beta. You ungear the beta if it is geared, then you cap it. You calculate capital asset pricing model. So you don't regear. You don't regear if you are calculating cost of equity on gear under APV. All right. So, but in this question, we have identified the beta to be 1.1. So, and this 1.1 is already ungeared because it's an asset beta. Asset beta is an ungeared beta. All right. So that's why we are going to ignore step 2. Step 3 is to now calculate capital asset pricing model. So straightforward. I will just come here. Capping, which is risk-free rates, cost of equity on gear equal to risk-free rate of return plus beta into market return minus risk-free rate of return. So the cost of equity on gear will then be equal to, according to the question, how much is the risk-free rate? What's the risk-free rate of return given to us?
6.
We are given a risk rate of return of 6. Okay. Then we're also given market return of the portfolio to be 13.5. 6 plus, then the beta is 1.1. Market return, return of the market, market return is 13.5 minus risk-free rate of return of 6. Therefore, cost of equity on gear will then be equal to, I will carry my calculator to say 13.5 minus 6 equal, then multiply by 1.1 equal, then plus 6, that's 14.25. Cost of equity on gear is 14.25%. So if that is the case, I will then go ahead to go and discount the free cash flow. So here is 14.25%. So with this, discount factor for year 1 would then be equal to 14.25 plus 1. That will give us 1.1425 raised to power 1 minus equal. That's 0.875. Here is 0.875. Then the next one will be equal to 1.1425. Is it what?
0.766.
0.766. Then year 3.
0.671.
671. Year 4.
0.587.
587. Year 5.
0.513, 514 now.
514. Then this
Yes,
one, year 6 will be
450.
450.
450. All right, so give me the present value now
Year 1,
for each
74.
year.
74, year
74.
1.
Yeah.
The last year, 72.9. That's 73.
73.
Year 2, 77.
77.
Second to the last year, 82.24. 82
82.
Year 3, 80.
80.
and 81.
81. So let's add up all the present value. Let's add up the present value. So this would be PV, present value of year 1 to 6.
467.
467. Here is 467. So the present value for the initial period is 467. So we need to calculate present value to infinity, which is the terminal value. All right. So I would then say PV after year 6 is year 7. So we need to calculate PV of year 7 to infinity, which should be computed as free cash flow of the base year. In the question, we are not given anything like growth rates. Therefore, it is constant. It means that the cash flow will be constant to perpetuity. Therefore, divided by cost of equity on gear multiplied by discount factor of the base year. All right. So now the free cash flow of the base year in this case would then be 162. The year before year 7 is year 6. So year 6 is the base year. So we are using year 6 cash flow to project for the future. Therefore, I would then say 162. Here will be 162 divided by the cost of equity long gear, which is 0.1425, multiplied by discount factor of year 6, which is the base year, is 0.450. So give it to me. This will give us present value of year 7 to infinity. So what do we have here?
512.
511.
512.
512.
512.
5. So add it up. What do we have there?
979.
979. This is 979. So this represents the total present value. Then you need to less the purchase consideration. Remember, base case NPV is total present value less purchase consideration. So according to the question, we are given the purchase consideration of 500 million. $500 million. The difference is 479. That 479 represents the base case net present value. So we have solved one side of the APV. We then move to the other side. So like I explained earlier, we are not given, there's no issue cost in the question. There's no subsidized loan, but we have interest. So we need to calculate PV of tax saved on interest. So number 2, calculating present value of financing effects. cash flow. So like I said, only interest is given in the question. Therefore, I would then say PV of tax saved. PV of tax saved on interest. So in the question, we are given interest from year 1 to year 5. Therefore, we then create a column for year, the interest, tax saved at 35%. Then we are going to have discount factor. Remember, when we had adjusted present value, I mentioned that the PV of financing effects, when you are calculating the PV of financing effects, you can either assume the cost of borrowing or the risk-free rate of return. And I advise that you should always use the cost of borrowing because cost of borrowing will always be higher than the risk-free rate of return. Okay? So according to the question, the 400 million naira debt is at 8%. Therefore, the interest rate is 8%. That's the cost of borrowing. Cost of borrowing is 8% on debt. So discount factor at 8%. Then we have the present value. Year 1, 2, 3, 4, and then 5. Give me the interest for year 1. The interest charges for year 1. Yeah. What's the interest charges for year 1?
32.
32. Okay.
36.9.
32, 27. Here is 32, 27. The next one,
20.
20.
20. Okay.
12 for 1.
12
1.
and then 1. That's 1 point. The last one is 1.3, right?
Yes.
Yes.
Okay, let's just put it there, 1.3. Now, you remember when you are calculating tax saved, you are supposed to multiply company tax rates on the interest. If you are calculating tax saved on capital allowance, you multiply company tax rate on capital allowance. But this is tax saved on interest. So 35% on 32, what you get? Give it to me.
11.
35, 11, okay. Next.
9.
9. Next.
7.
7.
7. Okay.
4.
4.
4. And then the last one,
0.5. 5.
0.5. Okay. So we need to discount this at 8%. So discount factor for year 1 at 8%. What do you have?
0.926.
0.926. 0.926. Year 2.
0.857.
85 watts.
7.
Okay. Next.
0.794.
Next.
0.735.
The last one.
0.681.
So give me the present value.
10.
10.
8.
8.
6.
Okay.
3.
3.
0.3.
0.3. So this will give us 18, 24, 27.3. Here is 27.3. So this is the total PV of financing effects. That's total PV arising from tax saved. So, sorry, this is 3. So in this case, we need to go and add it to base case NPV. So I will then come here. Our base case NPV is 479. So step 3 now is to calculate adjusted present value. If in the question you are given issue cost, subsidized loan, the same way we normally calculate PV of issue cost and the PV of net subsidy is the same thing you are going to do here. But because we are not given, so you have to use only what you have. Then number 3, calculating APV. Adjusted present value. Okay. We said that APV represent the base case NPV plus minus present value of financing effects. So we take the base case that we have computed previous base case NPV. We computed 479.
Yes.
We then had PV of financing effects, which arise from the
506.
tax saved on interest, which is 27. So approximately 27. So this is 506. All right. This is 506. This is adjusted present value. Like I said, adjusted present value is the total value. This is corporate value or enterprise value. So that's not the end. This is not what the examiner asks you to do. In the question, you are asked to advise the directors of Arsenal PLC. You advise the director of Arsenal PLC if whether they should proceed with the acquisition of Lacazette. So step 4 now, this will then be our step 4. I will then calculate equity value or additional equity value. Let's put equity value. Okay, we want to know how much is amount out of the 506 million, how much is attributable to equity. All right. So I would then say corporate value, which is 506 million. Out of the total value of 506 million, we are told in the question that the company should pay debt of 400 million naira at any available opportunity. So we have opportunity out of 506 million naira. So we need to pay debt. So this represents debt value, which is 400 million. The difference of 106 represents equity value. So according to the question, examiner is now asking us to advise the director of Arsenal PLC whether they should proceed with the acquisition. Advise the directors of Arsenal PLC should proceed with the acquisition of Lacassetti Limited, considering the additional equity value, considering the additional equity value of 106 million naira being created. All right, so that's end of the question. It's as simple as that. So anytime you want to value a business using APV, the normal thing you will do when you are calculating APV is what you are going to do. Nothing is different. All right. So that's all. That's end of the question. Let me know if you have any question on this so that we can solve another illustration. I'll be very happy if I can solve 3 questions. So that will be the end of valuation. So, but I doubt it if we can complete 3 tonight. So if there's no further question, then let's move to another illustration. Now let's have a scenario whereby business and financial risk will not change. So that will be the 3rd scenario. Let's have an example of that. In 2019, it was tested in 2019, whereby the business and financial risk remain unchanged. So as a result, you need to discount the free cash flow using the WACC of the combined businesses, the current WACC of the combined businesses. So I need one of you to read illustration number 6. All right, illustration number 6. That should be page 84, starting from page 84. Yes. Who is helping us to read? Let me see. Let me
Yes.
see. Okay. Go ahead, Minister of Finance.
Panto PLC will soon announce a takeover bid for Julia PLC, a company in the same industry. The initial bid will be an all-share bid of 4 Panto shares for every 5 Julia PLC shares. The most recent annual data relating to the 2 companies are shown below. Okay, we assume these figures are correct.
Okay, let me scroll down.
The takeover bid is expected to result in cost savings in advertising and distribution, reducing the operating costs, including depreciation of Panto from 76% of sales to 70% of sales. The growth rate of the combined company is expected to be 6% per year for 4 years and 5% per year thereafter. RT's debt obligation will be taken over by Panto. The corporate tax rate is expected to remain at 30%. Sales and costs relevant to the decision may be assumed to be in cash terms. Required. A. Estimate how much synergy is expected to be created from the takeover using free cash flow to the firm analysis for each individual company and the potential combined company. State clearly any assumptions that you make. Note, the weighted average cost of capital of the combined company is assumed to be 9%. B. Discuss any 5 limitations of the above estimate. Explain generally 3 advantages and 2 disadvantages of expansion through merger and acquisition rather than through organic growth.
Thank you, Minister of Finance. So that is the question. If guys not taking this question, can take you over an hour in the exam hall. It's a very big one. It looks very simple, but it's a very big one. It's straightforward, but the only thing is that we are going to compute present value for Panto. You compute present value for Julian, then you now compute another present value for the combined companies. So it's a lot. It's a lot. So if care is not taken, you spend over an hour on the question. All right. But in any case, examiner is asking us to estimate how much synergy is expected to be created from the takeover using the free cash flow to the firm analysis for each individual company, that is for Panto and Julian, and the potential combined company. State clearly any assumption that you make. All right. So when we are calculating for the combined business, examiner wants us to use WACC of 9%. So if that is the case, before we begin to solve, we need to check from the question. I've told you anything that whenever you are carrying out business valuation, you need to check from the question whether it relates to merger and acquisition. If it is for business combination, then in that case, those scenarios must apply. You need to check scenario 2 and scenario 3. Now, let's do that quickly. In the introduction, examiner told us that Panto PLC will soon announce a takeover bid for Julian PLC, a company in the same industry. So since they are in the same industry, that means business risk will not change. Okay? Business risk will not change because they're in the same industry. So I've identified one. So I need to go back to the question again and check if financial risk will change. And we said that financial risk will change if the business, if it will amount to paying additional debt, all right? Or if debt equity proportion after the business combination will change, okay? So let's first of all check from the table given to us. If we are given anything like gearing ratio after the business combination, all the information we have in this table relates to the current data. We are told that the most recent data relating to the two companies, this is for the two companies. All what you have in that table relate to the two companies. We are looking for the information after the business combination. So let's check paragraph after the table. You then told again that the takeover is expected to result in cost saving in advertising and distribution, reducing the operating cost, including depreciation of Panto from 76 of sales to 70% of sales. That one has nothing to do with debt. The growth rate of the combined company is expected to be 6% per year for 4 years and 5% per year thereafter. Okay. That RT is supposed to be Julian, it's a typo. So Julian's debt obligation will be taken over by Panto. Okay. So the company is taking over debt. You are not paying debt. You're only absorbing. When you acquire, as you are acquiring the assets, you also absorb the liability as well. But in this case, examiner is not saying you are paying, you are only absorbing it. So the tax rates, the corporate tax rate is expected to remain at 30%. Sales and costs relevant to the decision may be assumed to be in cash terms. So in this case, we are not paying any debt. Examiner did not tell us that they are going to pay debt. Therefore, we can assume that financial risk will not change. All right. Business risk will not change. Then financial risk will also not change. As a result, our valuation will be based on the third scenario. Okay. So in this question,
Sorry, sir.
business and financial risk. Let me rough this. Yes, talk to me.
Sir, what about their equity beta? They have different equity beta.
Where is it?
In the table that they share, sir.
I just said that now. The information you have in the table is meant for the two companies. It's not for after business combination. So whatever you are going to do must be after the business combination. So currently, Julian, Panto PLC has a debt equity proportion. This is the gearing ratio. This is the gearing ratio of the two companies. So gearing ratio is long-term debt over long-term debt plus equity by market value. So Panto has 30% gearing ratio, which means debt is 30%, equity is 70%. Again, Julian PLC has a 55% debt equity ratio. So which means debt is 35%, for 55%, equity is 45. So we are looking for gearing ratio after the business combination. We are not given, right? So what we are looking for is the gearing ratio after the business combination. All information you are going to be looking for must be after the business combination, not before the business combination. So what you have in the table is meant for the individual companies, not after the business combination. Is that clear, Yusuf?
Yes, sir. So
All
what it
right.
means is that the scenario will only work with what happens after business combination.
Yes, yes. What happened
Mm.
after the business combination? That's what I mentioned that, in my explanation in the previous class, in my explanation, I always emphasize that after I was mentioning it has to be after the merger or acquisition. Yeah. Okay then. So um, let me stop sharing this and move to the working notes. Now we want to calculate present value. I want to calculate market value of Panto, market value of Julian, and then market value after the business combination. So the first thing we are going to do is to calculate market value of Panto. Quickly, let's go through that together. All right. Let me see if this space will be sufficient. Okay, let me go to the next one. Solution. So illustration number 6. Is this 6 or 7? Let me confirm. Yes, illustration number 6. That is page 84. All right. Panto PLC. Now, the first thing, according to the question, you have requirements. Let me see. You have requirement A and B. So I would then say requirement A1. Requirement A1, calculating present value. Calculating present value, that is market value of Panto. Examiners say we should calculate for individual company and also for the combined companies. Our figures are in million. So let's see how we're going to do this. Now, I will then go back to the question. How many years are we given in the question? So when you look at the cash flow given to you in the table, under the other information, you are told that expected annual growth rate in sales, operating cost, including depreciation, replacement investment, and dividend are for the next 4 years. So for the next 4 years, so you are supposed to calculate present value for the initial period for 4 years. So in this case, I can do year 4, year 3, year 2, and then year 1. If I like, to make life easy for you, let me see if I can, we can do a working by one side before the years. Let me create a column for working. So let me create an additional column here. I don't know the extent of my table. Let me just create. Yeah. So the first item, remember, when you are valuing a business, the first thing you are going to do is to calculate free cash flow to the firm. Therefore, I will then go back to the question, how am I going to calculate free cash flow? Examiner told us in the question that we are given revenue of Panto, if 13 figures are in thousands, so not in million. So we are given revenue of 13,333. Then you are now told in the question that from the table, we are told that expected annual growth rate in sales, operating costs, replacements, investments, and dividend for the next year are supposed to grow by 5% for Panto. All right. All the cash flows will grow by 5% for Panto. So if that is the case, let's grow we have been given a current value. So this is sales. So sales of 1 million, sales of 13,333. We are told that it will grow by 5%, therefore multiply by 1.05. So give it to me. What do we have? Figures are in thousands, not in million.
14,000.
14,000. So what you have in your calculator, multiply by 1.05.
14,700.
14,700. What you have in your calculator, multiply by 1.05.
15,435.
15,435.
16,000.
Let's do it this way. I need only one person to be giving me a figure. Chinozo, mute. I need only one person so that the cloud, there will be sanity. All right. So, Faith, you want to be giving me a number, right? Or Minister of Finance.
Okay, sir.
Yeah. So, what's the next one?
So I'm coming. I wiped my calculator off. 1.05.
I have
So, what's
a
for the year 4?
question.
If you want to talk to me, always raise your hand. You know the rules now. What's your question? You've already spoken, so talk to me. What's your question?
Sorry, sir. I thought the growth rate is 6% for the first 4 years.
No, in the table is 5%. Examiner say 5%, not 6. From the table, you are told that annual growth rates, expected annual growth rate in sales, operating costs, including depreciation, replacement investments, and dividend for the next 4 years is 5% for Panto, 6.5 for Julian. The 6% you are seeing there is after the business combination. Do you get that, Faith?
Yes, sir.
The 6% is for after the business combination.
Thank
Right
you.
now, we are doing for only Panto. Once we are done with Panto, we do for Julian. After Julian, we can then do for the combined. Yes, Wumi, talk to me.
Okay.
Wumi, what's your
Yes,
question?
sir. Good evening, sir. Please, how did we get that 13 million?
It's in the question. The 13,333 is in the question. That's the sales value for Pancho.
Okay.
13,333. Yeah.
16,206.
Okay. Yeah. 16,206.
Yes, sir.
So we have grown the sales value. We have grown the sales value. Then after this, we need to consider, we then go back to the table. We're also given operating costs. We are given operating cost, and we are told that operating cost included depreciation. So operating cost in this question for Panto is 8683. So I will then come here operating cost. Operating cost 8683 plus depreciation. How much is depreciation for Panto? Minister of Finance, how much is it?
1,450.
1,450. Because examiner has told us that operating costs include depreciation, and which is the normal thing. You know, in your profit or loss accounts, depreciation is usually included in the operating cost, that is operating expenses. So here is 1,450 at inflation of 5%. So multiply by 1.05. So add the two together. So what you are going to do is 8683 plus 1450.
Times
That's
1.
10,133. Then multiply by 1.05.
10,640.
So what do we have?
10,640.
10, 6, multiply by 1.05.
11,172.
172. Multiply by 1.05.
11,730.
11,730. Multiply by 1.05.
12,317.
317. So we are done with operating costs. After operating costs, I will then go back to the question. Of course, after operating cost, we are supposed to get operating profits. Okay, we are supposed to get operating profits. So I will then come here, find the difference. What's the difference between the sales and the operating cost?
The first year,
Yep,
3,360.
3360. Next one,
3,528.
3528. Next one,
3,705.
705. And then year 4,
3885.
3885.
889.
All right. 889 or
Is
885.
889.
Oh, okay. So this represents the profit before interest and tax. Immediately after this, remember, this is free cash flow to the firm. So you are not going to deduct interest expense. So I will then come here. Immediately we pay tax. I will then go back to the question, what is the tax rate for Panto from the table? How much is the tax rate for Panto? Tax is 30% for each of the companies. So taxation is 30%. So at 30%, so what's 30% of 3360?
1008.
Yeah.
1058.
1008. Next one.
1058.
10558.
1112.
Okay.
1112. Yeah. Then the last one. 1167.
Okay. So that represents the tax liability. Then after tax, we need to add back non-cash item like depreciation. In the question, we have depreciation. And depreciation for Panto is 1,450 at 5%. Therefore, 1.05 multiplied by 1450. What do you have? Remember, this depreciation, you have added it to the operating cost. So, because we are calculating free cash flow, so we need to add it back. It's not a cash flow.
1523.
Pardon, take it again.
1523.
1523. Next one. 1523 multiplied by 1.05.
1599.
What you have in your calculator multiplied by 1.05.
1679.
1679 multiplied by 1.05.
1762.
1762. So after depreciation, we need to consider changes in working capital. I will then go back to the question, do I have anything like working capital? Let's go to the table. Are we given working capital? Okay, nothing like working capital. So if there is no working capital, the next thing we need to do is to consider capital expenditure. We need to consider capital expenditure. So according to the question, we are given annual replacement capital expenditure, 1,600 for Panto. We are given capital expenditure of 1,600 for Panto. So if that is the case, I will then come here, capital expenditure, 1,600 at 5%. So 1.05 multiplied by 1,600, what do you have?
1680.
1680 multiplied by 1.05.
1764.
Multiplied by 1.05.
1852.
Multiplied by 1.05.
1945.
1945. All right. So that's that. Then at this point, we need to get the free cash flow to the firm. So let's sum it up. Let me pick the last one. 3,889 minus 1167 plus 1762 minus 1945.
2195. The first one.
That's 2195. I'm coming. This is 2539. Here is 2195. Okay.
The third one, 2420.
Yeah.
Third year,
242. Okay.
2305.
305.
2305. Right. So this represents the free cash flow to the firm. So we need to discount this at the appropriate cost of capital, discount factor. We have identified from the question that business risk and financial risk will not change. Why? Because the two companies, both Panto and Julian, they are in the same industry. Then two, financial risk will not change because we are not told in the question that additional debt will be paid. Since we are not told that, also, examiner did not tell us in the question that debt equity proportion will change after the business combination. Therefore, we have identified that business and financial risk will not change. So we are supposed to discount this free cash flow to the firm using the current WACC of individual, we are using the individual company's WACC, the current WACC of individual company. That is the current WACC of Panto, current WACC of Julian, then the WACC of the combined business. Then the examiner has us to use 9% for the combined. So let's move on. Let's go and calculate the current WACC. I will then go back to the question. How do I calculate the WACC, the weighted average cost of capital of Panto and then Julian? According to the question, which information am I going to use? Examiner has given me risk-free rate of return. I have market return. I have equity beta of individual. I have equity beta for each company. Then in this case, I'm supposed to use capital asset pricing model to calculate cost of equity. Then if I'm done with my capping for each company, then I need to calculate what is the debt value, what is the cost of debt for individual company. Examiner has told us in the question that which information do you have for debt? Yes. Let me see. Yes, we are told that current market cost before tax of fixed interest debt is 6% for Panto and then 7.5% for Julian. So that's the cost of debt. That's the KD. That's the KD for each company. So without wasting time on this, let's quickly calculate the cost of equity, cost of debt. So this would be for Julian. This page is for Julian. Sorry, for Panto. The next one is for Julian. Then without moving too far away, let's do our working here. Let's do our working there. Once we are done with our working, then we do for the combine in the last page. So I can then come here, workings. So we want to calculate working number 1, calculating cost of equity. You have to know what to do next. Cost of equity using capping. The information you have in the question will tell you what next you should do or the variables you should look out for. So we are calculating capping because we are given information on capping. So using capping, cost of equity equal to risk-free rate of return plus beta into market return minus risk-free rate of return. So in this case, for Panto, cost of equity will be equal to the risk-free rate of Panto, according to the question, is risk-free rate of return is a general thing, is 4%. Risk-free rate of return is 4%. Then beta of Panto, equity beta of Panto is 1.18. So here is 4% multiplied by equity beta 1.18. The market return for Panto, market return is 11%. All right, market return is 11% minus risk-free rate of return. So cost of equity of Panto will then be equal to 11 minus 4, which is 7 multiplied by 1.18 equal, then plus 4 equal 12.26. Cost of equity of Panto using capping is 12.26%. All right. Then let's calculate cost of equity for Julian. So KE equal to 4 plus risk-free rate of return is a general information. It's not relating to any, it's not specific to any company. Then the beta, equity beta of Pancho is, of Julian, 1.38. Let's calculate the cost of capital once and for all. Here is 1.38. The difference between 11 and 4 will give us 7. Okay. So for Julian, cost of equity will be equal to 7 multiplied by 1.38 equal, okay, then plus 4. That's 13.66%. So that's the cost of equity of Julian. Then let's calculate the WACC. We then calculate the WACC. Sorry, before that, cost of debt, KD. Cost of debt, KD. So how do we get the KD? After tax cost of debt. So KD will be equal to interest. According to the question, for Pancho, we are told that the current market cost before tax of fixed interest debt, which is the KD, is 6% for Pancho and then 7.5% for Julian. So 6% is the KD. So KD is interest multiplied by 1 minus tax. So for Pancho will be equal to interest of Panto is 6% multiplied by tax rate for the two companies is 30%. So we are supposed to account for 70%. Therefore, for Panto, 6 multiplied by 0.7. 6 multiplied by 0.7. That's 4.2. Here is 4.2%. Then for Julian, after tax cost of debt, before tax cost of debt is 7.5% into 0.7. Let me confirm whether it's 7.5.
Yes.
Yeah, 7.5. Okay. So
5.25.
5.25. Here is 5.25%. So 3. We need to calculate the WACC. Now that we have the cost of equity and then cost of debt, we need to calculate WACC for each company. To get the WACC, you know that WACC is equal to equity value over equity plus debt multiplied by cost of equity plus debt value over equity plus debt multiplied by cost of debt, 1 minus tax. Already we have adjusted for tax, so we are going to ignore that 1 minus T. We've already adjusted for tax for the KD. So for Panto, WACC of Panto will then be equal to the equity value of Panto. Let's go back to the question. What's the debt equity proportion of Panto? According to the question, we are given Gini ratio, long-term debt over long-term debt plus equity by market value. 30% is the debt equity proportion of Panto. So if debt is 30%, equity will be 70%. Therefore, so if you like, you can do 70 over 100, or you say just say 0.7. You are still saying the same thing, but let's use 70 over 100 because some people may still ask me, why don't I divide by 100? So let's just put it there. Now, we have calculated cost of equity of Panto to be 12.26. Cost of equity of Panto to be 12.26. Multiplied by 12.26%. on the left plus debt value is 30%, that is 30 over 100, multiplied by after-tax cost of debt we have computed for Panto. The after-tax cost of debt for Panto is 4.2. KD is 4.2 after tax. Multiplied by 4.2. So there is no need to say 1 minus tax again. We've already adjusted for tax. So from the left,
8.58.
8.58. Here is 8.58%. Then from the right,
1.26.
1.26. 1.26%. Add the two together. Yes, 1.26. Add it together.
9.84.
9.84%. So approximately the work of Panto is equal to 10%. It's approximately 10%. Okay. Then let's calculate the current work of Julian. Let me do it this way. Okay, let's do it this way. This is for Panto. This is KW. For Panto. Then Julian. Then for Julian, KW will be equal to the debt equity proportion of Julian is 55%. So debt is 55%, equity is 45. So 45 divided by 100 multiplied by cost of equity of Julian. I think it's 13 point something something. We calculated 13.66. Multiplied by 13.66% plus debt value is 55%. So 55 over 100 multiplied by after-tax cost of debt, which is, I think, is it 5 point something percent? Let's see, 5.25. 5.25 after tax. Again, there's no need for you to say 1 minus tax. You've already adjusted for tax. So give me from the left.
6.15.
6.15% plus the right.
2.89.
2.89%. Add the two together.
9.04%.
9.04%. So the work of Julian is approximately 9%. So we can then go back to our calculation. See the way we are taking it step by step? That's what is expected of you. But for you to be able to do it this way, you must know what you are doing. You have to practice as many questions as possible to gain your confidence and become experts. So for Panto, the current work is 10%. Therefore, there will be points 907 826 751 683. So let's get the present value for the initial period.
The first one should be
PV.
0.901.
0.901.
No, I
Are
mean
you sure?
the discount factor.
Okay. 1.1 raised to power 1 minus
909 rather.
909. Yeah, I intended to write 909. Oh yeah, put it there. What do you have? Present value?
1995.
1995.
1904.
Okay.
1817. 3.
1817.
1734.
1734. So let's get the PV for the initial period. Total, add it up. PV of year 1 to 4. That's the initial period.
7450.
7450. Then we need to calculate PV from year 5 to infinity, which should be free cash flow of the base year. There is growth rates. Examiner told us that there is growth rates after year 4. When you go back to the table, you are told that expected annual growth rate in sales, operating costs, including depreciation, replacement investment, and dividend after 4 years is 4% for Panto, then 5% for Julian. That is, the growth rates to infinity is 4% for Julian, for Panto. So in this case, we are going to include the growth over the WACC. Let me just put WACC. WACC minus growth rate multiplied by discount factor of the base year. All right. So you then say free cash flow of the base year. Now, what is the base year? Base year is year 4. What's the free cash flow of year 4? 2539. Here is 2539. Growth rate is 4%, 1.04 over the WACC of 10%, 0.10 minus growth rate of 4%, 0.04. Discount factor of the base year, 0.683. So give it to me. So this will then give us 2539 multiplied by 1.04 equal, then divided by 0.06 equal, multiply by 0.683. 683. I think 683 is the cash flow, is the discount factor of year 4.
I'm
Okay,
having
that's
058.
30,058. Here is 30, 0. Pardon?
Yes, it's correct, sir. 30058.
What do you say you got? What did you get?
30058.
Okay, so this is the present value of year 5 to. Okay, so add the two together.
3750.
7508.
Year 5 to 37. You said 37508. So this represents the total PV, that is market value. of total PV of Panto. Okay, that's total present value. As at this moment, the economic worth of Panto is 37,508,000 naira. So I'll keep it on one side. The same way that I've calculated for Panto, I will also do for Julian. Okay, I will do for Julian. That's what I told you the other time, that if care is not taken on the day of your exam, we will spend over an hour. You wouldn't know that time is going. It looks very simple, but it's tedious. All right, so let's do for Julian. Number 2, calculating present value or market value for Julian. Our figures are in thousands. So the same way we calculated for Panto. So this will be for year 4, year 3, year 2, and then year 1. Okay. All right. So I'll give you a space. All right. So what's the sales? What's the sales value of Julian from the
9
table? 9,400. Here is 9,400. What's the growth rate of Julian?
6.5%.
The growth rate of Julian in cash, 6.5%. So at 6.5%, therefore, 1.065 multiplied by 94. What do you have for year 1? Let's move faster.
10,011.
10,011 multiplied by 1.065.
10,662.
Multiplied by 1.065.
11,355.
Multiplied by 1.065.
12,093.
Okay, so we then deduct operating costs. The operating costs in the question, we are told that included depreciation. So what's operating cost of Julian?
5,450.
Operating cost of Julian, 5,450. Okay, 5,450 plus depreciation. How much is depreciation of Julian?
1,100.
1,100. So multiply by 6.5%. Multiply by 1.065. So add the two together. We are going to have, I think, 6,550 multiplied by 1.065.
6,976.
What do you have?
6,976.
69. Okay. So multiply by 1.065.
7,429.
7,429 multiplied by 1.05. 1.065.
7,912.
Multiply by 1.065.
8,426.
8,426. Okay. So let's get the profit before interest and tax for each year.
Okay.
Okay.
Is
3035.
3,667.
3,000 what?
35 for the first year.
667, number 4.
3,600 and
No.
Number 4, sir. Number 4.
number 4 is what?
3,667.
Okay.
The first year, 3035.
3065
35.
35 3035.
Yes, sir.
Yeah, 3.
Yeah.
3443.
4443. Okay.
3443.
344.
Then year
Then
2.
year 2.
3233.
32
Three.
2
32.
33.
Yes, sir.
33.
Okay. So now that we have the profit before interest and tax, the next thing we need to do is to pay tax. And we're told that tax is at 30% for Julian also. Therefore, 30% of 3035, what do you have?
Nine 11.
909 911. I will 910.
Next,
970.
okay. Next,
1033.
1033.
the last one.
1,100.
Okay. So now that we have deducted our tax, then we need to add back non-cash item, which is depreciation. So depreciation is 1,100 at growth rate of 6.5%. Therefore, give it to me. 1.065 multiplied by 1,100.
1,172.
1,172 multiplied by 1.065.
1,248.
Okay, next one.
1,329.
And the last one.
1,415.
Okay, 1415. So after depreciation, we don't have working capital, so we consider capital expenditure. So according to the question, the capital expenditure for Julian is 1240. Annual replacement capital expenditure is 1240 for Julian. All right. So that will grow by 6.5%. 1240 at growth rate of 6.5. So what do you have? 1.065 multiplied by 1240.
1321.
1321 multiplied by 1.065.
1406.
1406 multiplied by 1.065.
1498.
1498 multiplied by 1.068.
1595.
1595. Okay, so let's get the free cash flow for each year.
Okay. Year 1,
Yeah.
1975.
1975.
Year 2, 2098.
2098.
Year 3,
Yep.
2241.
2241.
Two, 2387.
2387. 2387. Now that we have the free cash flow, we need to discount it at the current WACC of Julian. We have calculated the WACC of Julian to be 9%. Therefore, what's the discount factor for year 1 at 9%?
0.917.
0.917. Next.
0.842.
Next.
0.772.
And the last one.
0.708.
708. So let's multiply to get the present value.
Sir, excuse me, sir.
Yes. Yes, I'm listening.
Free cash flow for the factory for this for number 2, I think it's 2105. I think let the recheck, sir.
Okay. Yeah, Minister of Finance, check for year 2. 3233
Free cash flow.
minus 9.
Recheck, please.
Yeah.
Because I get 2105.
Okay. 2105.
Okay. Thank you. 2105. Thanks for spotting that. So let's get the present value now.
Year 1,
Yep.
1811.
1811.
Year 2,
Year
1772.
1772.
72.
Yes, year 3.
Year 3, 1730.
1730.
Then the last year, 1690.
Okay. So add up all the present value for each year. That will give us the PV of year 1 to 4.
7003.
7003. The figures in thousands. So we need to calculate PV of year 5 to infinity, which is the free cash flow of the base year of 2387 multiplied by the growth rates after year 4 for Julian, according to the question, is 5%. Growth rates after year 4 for Julian is 5%. So it's in the table. 1.05 divided by the WACC of Julian. The WACC of Julian is 9% minus growth rate of 5% multiplied by discount factor of the base year, which is 0.708. So the PV of year 5 to infinity would then be equal to, what do you have?
44362.
44362. All right. So you add it up to get the total present value. Total
51365.
present value. So 51365. Okay. So that's total present value of total market value of Julian. Now, we need to calculate the present value before the acquisition, before the takeover. Okay, so let's add the two together. So present value before takeover. Let me see, let me check something there. $37508. Total present value of Julian. All right. Then we need to determine pre-working number, sorry, step number 3 now. Calculating pre-acquisition market value of both companies. What's total market value before the acquisition? So present value of Panto is 37. Is it 37? Let me confirm again. Present value of Panto is 37,508. Is 51 365. Let me write that. 365. So add the two together. 37508 plus 51365. That's 80.
873.
88.
873.
That's 888.
That's correct, sir. Then 73.
8873. Okay. So this represents the pre-acquisition market value. Yes. All right. So we are done. We have not completed number A requirement. The next thing we want to do now is to then calculate the post-acquisition market value of the combined. So let's do that quickly. You can see, let's use this page. Number 4 or 5, number 4. Step 4, calculating post-acquisition market value of the combined companies. The same way we did for individual is the same way we are going to do for the combined. So let's design our table. This is for year 1, year 2, year 3, and then year 4. Now, when you are calculating the market value for the combined, emphasis should be based on information after the business combination. Mostly you are less concerned with what you have in the table. You are going to concentrate on the information after the takeover. So the paragraph after the table, you are told that the takeover is expected to result in cost saving in advertising and distribution, reducing the operating costs of Panto from 76% of sales to 70% of sales. So what the examiner is telling you is that, of course, without wasting time, If operating cost, instead of you to be calculating operating cost again, all you need to do is to just take 70% of sales. Therefore, first thing first, we need to get the combined sales. What is the combined sales? So, to get the combined sales, you are supposed to add together the sales revenue of Panto and the sales revenue of Julian. So you add it together, then you grow it with the growth rate given to you after the business combination. So the growth rate, you are told that the growth rate of the combined company is expected to be 6% per year for 4 years and 5% per year thereafter. Therefore, all the cash flows is 6% after the business combination. So I would then say sales. The sales of Panto is a 13,333 plus sales of Julian. Sales of Julian is
94.
9,400. All right, 9,400. And the examiner told us that this will grow at growth rate of 6%. So add the two together, 13,333 plus 94 equal, multiply by 1.06. Give it to me.
24,097.
That's 24,000. 2409. You said
7.
0. Okay. 097. 24,097. Okay. Then multiply by, okay, you have grown it with 6%, right?
Yes, sir.
So what you have in your calculator, multiply by 1.06.
25,543.
25,543 multiply by 1.06.
27,075.
075 multiply by 1.06.
28,700.
Thank you. So that's the sales value. So examiner now told us that the operating costs will reduce to 70% of sales. Therefore, I would then say at 70% of sales. So what's 70% of 24097? Yeah, Minister of Finance.
16,868.
16,868. If I don't want to do it this way, since operating cost is 70% of sales, I can just do operating profit to be 30% of sales. That will save time. But in any case, let's move on. Next
Okay.
one, 70% of 25,543.
17,880.
17,880. Okay, let's do it this way. 17,880 minus the sales value instead of starting all over again. Or have you canceled it from your... Have
I
you
did
canceled it? Okay, yeah, let's just move on. Next one.
27,075. 18,953.
18
953.
minus 27,075. Let's get the answer once and for all. Operating profits.
Then the last one. Okay. The last year.
Yeah,
20,090.
090. Okay, so let's find the difference then.
8122 for the third year.
8122.
The first year. 7,229.
7229.
7663. Second year.
7663.
Year 4, 86.
8610.
10.
So after profit before interest and tax, we pay tax. Now we need to go back to the question. What is the tax rate after the business combination? Or is this the same thing as 30%? Let's check. Okay, so we are told that corporate tax is expected to remain at 30%. So in that case, here is 30%. So what's 30% of 7229?
2169.
2169. Okay. Next,
2299.
2299. Next,
2437.
2437.
37.
The last
25
one.
2583.
8.
Okay. So depreciation. What's the depreciation of Julian of Panto? 1450, right? The depreciation of Julian is 1100. Okay.
Yes, sir.
Then this will grow by 6%. You add up the depreciation of the two companies, you grow it by 6%. So 1450 plus 1100 equal, multiply by 1.06. What do you have?
2703.
270
2703.
multiply by 1.06.
2865.
2865 multiply by 1.06.
3037.
3036. 37, okay. The last one.
3219.
3219. Then the next thing is to consider capital expenditure. Since there is no working capital, so we consider capital expenditure. Capital expenditure for Panto, I think is 1600. Let me confirm. Capital expenditure of Panto from the table, 1600, and 1240 for Julian. 1600 plus 1240 will grow by 6%. So add the two together, 2840 multiplied by 1.06. What do you have?
3010.
3010 multiplied by 1.06.
3191. 91.
91. Okay, multiply by 1.06.
3382.
And the last one,
3585.
3585. Okay, so let's get the free, add it up. Let's get the free cash flow. Yeah. What's the free cash flow?
Four seven five three. Positive.
4753.
5038. Year 2.
5038.
5340.
5340.
Year 3. 5340.
Okay, year 4.
And year 4.
5661.
5661.
5661.
Okay, so we have calculated discount factor before for Julian. So what's discount factor for year 1? 0 point at 9%. Remember, in the question, examiner said that we should assume 9%. We are to assume 9% for the work after the business company. Let me go back there. Note,
0.917.
the weighted average cost of capital of the combined company is assumed to be 9%. So, yeah, it says 0.917.
17.
So for year 2,
842.
year 3,
772.
and then year 4,
708.
70. So let's get the PV.
Year 1,
4359.
4359.
Pardon?
4359.
4359. Okay.
Year 2, 4242.
4242.
4122. Year 3.
4122. Year 4,
4008.
4008. So add it up. This will be the PV of year 1 to 4 of the combined.
16731.
15,
7,
16.
16,
1.
731. So we need to determine the PV to infinity, present value from year 5 to infinity. The free cash flow of the base year is 5661. 5661. The growth rates after year 4, according to the question, we are given a growth rate of 5% per year thereafter. Okay, so multiply by 1.05 over the WACC of 9% minus the growth rate of 5%. Multiply by discount factor of the base year, which is 0.708. So give it to me. What's the present value from year 5 to infinity? PV of year 5 to infinity.
105 to 10.
105,210. So add it up.
One two one 941.
121,941. So this represents the post-acquisition market value. This is post-acquisition market value of the combined. All right. So according to the question, examiner wants us to estimate how much synergy is expected to be created from the takeover using the free cash flow to the firm analysis for each individual company and the potential combined company. So far, we have calculated the post-acquisition market value. We have also calculated the pre-acquisition market value of the combined. Let us determine the synergy. Let's determine the synergy. This would be number 5. Is it 5 or 6? Let me check. Step 5 or 6 of the calculation. This is 4. Okay, 5. Step 5. So synergy is just like additional value to be created. So estimate how much synergy is expected to be created. So I can just say synergy created. All right. Synergy. Figures are in million. let me help you a little bit. I can say the synergy created, the synergy to be created represents the difference between the post-acquisition market value the post-acquisition market value of the post-acquisition market value and the pre-acquisition market value of the combined companies. Okay, this is shown as follows. Okay, so I can then say synergy created figures are in thousands. I will then pick the pre-acquisition market value that we have calculated, which is 121. Let me check. 121,941. 941. Sorry, this is the post. I wanted to say post. Minus the pre-acquisition market value of Panto and Julian. Let me push this one to the front. 121,941. So the pre-acquisition market value of Pansol and Julian we calculated before was 88,873, 88,873, 88,873, 88,873. So what's the difference?
33,068.
33,068. So I can then say, so examiner is asking me to estimate how much synergy is expected to be created from the takeover. So I can then say the synergy or the expected synergy, the expected synergy. Let me write that. From the takeover is 33,068,000 naira. That's it. You can see 20 marks. We have been sweating over 20 marks since. So please, like we always advise, when you are because when you are under exam pressure, there's likelihood of mistake. And that's why you don't rush to start from the compulsory question, because compulsory question can throw you off balance, especially if it's something you are not getting. All right. If it appears to be difficult, please don't make it your first attempt. Always go for 20 marks, 15 marks kind of question. You can pocket like two or three 20 marks. You can do one of 20 marks or do two of 20 marks, then one of 15 marks. Just go and do the cheapest one first. Then you can then come and balance on the compulsory question to maximize your marks. All right? Because if you start from the compulsory question, you won't know. Even if you are getting it, you won't know that time is already time is going until invigilator will now tell you that 30 minutes more and you are still working the compulsory. And as you are working, you have to be checking your time to ensure that you are not spending too much time on a particular question. So please, you must do well to maximize your score. Compulsory is 30 marks. Therefore, you should be aiming between 22 and if not 30, you should be aiming between anything from 22 and above. You are okay. All right? You are okay. So please, don't waste time. At this moment before your exam is around there. Today is the 20th. Your exam is less than, let's say 30, 37 days. You have about 30, what am I saying? 27 days. Your exam is about 27 days now, So you can see there's no time for all you need to do now is to be practicing. You need to be practicing. The more you practice, the better for you. For you to be able to gain your confidence, you need to practice, expose yourself to different exam question and answers. So different scenarios. When you're able to do that, then of course your confidence will be as high as ever. But if you don't practice find question before going to the exam, there's no how you are going to have challenge on that day. If you don't practice, time yourself, practice question and answer. If you don't do that, you are going to have challenge because when you see scenario that is different from what you are familiar with in the class, so you are going to struggle. But if you have practiced as many questions as possible, there's likelihood that you are going to see a scenario that is related to what you have seen before or what you have practiced before. Please, we beg of you, ensure you practice, practice, practice so that you'll be able to time yourself. Okay, on the compulsory question, I'm not supposed to start to spend more than 45, maximum 15 minutes. Okay, so you need to do all of this. Otherwise, you will spend so much time on a particular question and then you won't have time to do the other ones again. All right. So, yeah, so this is where we are going to stop today. Yes, we still have the B part of the question, which is asking us to discuss any 5 limitations on the above estimates. Explain generally 3 advantages and 2 disadvantages of expansion through merger and acquisition rather than through organic growth. Okay, additional 10 marks. All right. So let me see. Let me use Golden Book to just explain this. Or possible I can just share with you. But first thing first, let me see if I have Golden Book. Let me stop sharing this. Let me see if I can lay my hand on the Golden Book. So, okay, just a moment. Let me open the material. To just show you. Let me search for Panto. Okay. Let's see. Just a moment. Okay. Panto. No, that's too much. All right. Okay, let me share. Seen it. Some of you have disappeared. Some of you, since almost 1 month now, only few of you are joining the class. At times, 20 people or a little bit over. At times, less than 20 people. Some of you have stopped joining. I believe they've known it already, or maybe they don't have time. Let me see. Solution to the B parts. Yes, what are the assumptions? Of course, the assumption is still consistent with what we used to do, right? So we talk about cash flow, we talk about interest, we also talk about cost of capital. On the cash flow, what are the assumptions? It is assumed that the cash flow estimates are realistic and will occur at the end of each year. All the sales value given to us, the operating cost, the depreciation, all those cash flows will occur, they are realistic estimates and they will occur at the end of each year. That's the first assumption. The second one is interest. It has been ignored in the calculation because it has already been included in the WACC. We are given interest rates of, let me see. We are given, let me go back to the question before. In any case, that's just the assumption so that I don't need to be switching from one page to another. All right. So cost of capital, the WACC of the combined companies of 9% is assumed to be appropriate and then consistent with the cash flows. All right. So these are these are some of the assumptions in the question, but I pick only three. All right. Then what are the limitations associated with our calculation? The estimates are based upon unrealistic assumption and are subject to considerable margin of error. Some of the limitations include: one, according to the question, we are told that sales, operating costs, replacements, investments, and dividend are unlikely to increase by the same proportion. Remember, for Panto, examiner told us that the cash flows for the next 4 years will grow by, was it 5% or 6%? So which is not the same thing. It's not possible that sales, operating costs, depreciation, everything will grow at the same growth rate, at the same growth rate. So that's not realistic. That's the limit. That's one limitation in the question. Two, forecast of future forecast of future growth rates may not be accurate. Okay, they are forecasted for future growth rates to be was it 5% or 4%? Okay, Panto is unlikely to have access to enough internal information about the activities of Julian to make accurate projection. So for saying that growth rate will grow by a specific future growth rate will be at a particular rate may not be accurate because the company that is making the takeover will not have full information or full access to internal information of Julian. So as a result, they cannot make accurate projection for the cash flows arising from Julian. All right. Number three, the expected reduction in operating costs may not be achieved. We are told that operating costs will reduce to 70% from 76%. So this is just a projection. The actual may be different for what they projected for. It's just an estimate. All right. Then number four, the estimates are based upon present value to infinity of expected free cash flow. A shorter time horizon may be more realistic. Yeah. So the longer the projection into the future, the longer the higher the margin of error that will arise. Okay, so these are some of the uncertainty associated with the question, with the calculation. So you can just have a look All right. Then, if possible, I will just scrub it and share with you so that we can close the class. Then the advantages and disadvantages too. So I will screenshot it and I will share with you later on. All right. So let me know if you have Minister of Finance, go ahead.
Thank you for the class. My question is
Yeah.
relating to the last topic we tweeted. We solved
Yeah.
one question of recent that asked us to do NPV and IRR. So my question is, that particular question, I later solved it and got the answer that gave me 0 NPV. Now that the question said we should go ahead and calculate IRR,
Yeah.
is there need going ahead to do that again? Since I already have 0 NPV, it means that the cost of capital I use for my NPV is okay for the IRR. So in exam situation, it's possible that there is probably rounding up error because the 2 times or the 3 times I did it, the figures are not the same, probably due to rounding figures. So, but when I get 0 in exam hall, are we saying we should redo the question again, or the IRR will be assumed to be that 0 and that cost of capital that was used to discount the net cash flow?
Yeah, we said that internal rate of return is the rate that equate the present value of future cash flows to 0. Is the rate that equate the NPV of the future cash flow to 0. Now, any rate that you assume and produce 0 NPV, that's your internal rate of return. Do nothing. Once you have calculated NPV and you get 0 NPV, that is the rate you are looking for. So there's no need for you to calculate internal rate of return again. You have seen the answer. All right. I think we solved the question in the class now.
Yes, in class
Uh-huh.
we got 1, but when I solved it,
No. Well, the reason why we got 1, I think it was because there was during the rounding.
yes.
So it was because of the rounding. It's usually supposed to be 0. Yeah, NPV is
So,
supposed to be 0. Even when you get 1, if you get NPV of 1, you can see 1 is close to 0. So it's assumed that rate you use is the internal rate of return.
okay, so the 5
Yeah.
marks for IRR computation is bonus 5 marks, Kenan.
Yeah.
Okay, thank you, sir.
You're welcome. Yes. Any question? Come. I've not heard of Charity. This Charity, are you still in the class? Because I know you came in briefly, you asked a question, and since then I've not heard from you again. Charity is no more in this class. She has disappeared. I trust her. Recently, you have been skipping the class, Charity. The same thing you did last time, I was asking for you because I know you surely ask question. You know, it's only Ufoma that asked question today. It's okay. All right then. So in the absence of no,
Sir,
yes,
sorry,
talk.
last week, the question we saw, question 5. I noticed we did the A part. We didn't do PE and C. The last question we solved last week.
Which question was that? What's the name of the company?
5. That's
Echo PLC, sir.
Echo PLC, yes. Echo PLC.
So, okay. We did not do.
B and C.
Oh, you would have reminded me now when we started. Would have reminded me. In the B part of the question, examiner was asking you that you should calculate additional funds required to finance, additional funds required for the premium, and also how the premium will be financed. All right. Even though we have, okay, let me quickly run through that. Let me stop sharing. Okay, let me even use this one, Seth. Let me check. You know, you've already calculated the additional funds required, which is 480 million. The total premium loss is 480 million. You are supposed to pay premium of 30%, and then the management of BOPSC is asking for 50%. So the additional premium of 20% you paid was 480 million. All right. So that's the additional funds that you are looking for. The examiner asks you to calculate. Then the examiner is now asking you, how do you finance the additional premium? Of course, examiner is simply asking you how to finance merger and acquisition transaction. There are several ways you can finance, but three common methods of financing M&A transaction is one, through issue of shares, through cash payments, and then through debt. Those are the three common ones. I want to open the question so that it can't take us more than 1 or 2 minutes. Okay, this is it here. This is it here. So let me see. The additional funds required. This is the additional funds required. The additional funds required is 480 million calculated as so. You are supposed to pay the company EPPLC. The management of EPPLC has capacity to pay only 30% premium, but BOPSC is asking for 50%. So examiner is now asking you, what is the additional funds required? The additional funds is the extra 20% you are paying on the premium. So you are paying additional premium of 20% on the current value of BO. So 20% of 2,400, that's what gives us this 480 million. That's number C1. Then number C2. Number C2, examiner is asking us how to finance the premium. How to finance the premium. Of course, the premium can be financed. Okay, the premium could be financed by any of our combination of the following. One is cash payments. So it's not just you are not just going to say cash payments, debt, or share exchange. No, you need to explain. You need to say something in summary. You need to summarize your point. Don't make it too wordy. Just summarize your point. What are the limitations if you finance with cash? What is the implication? If you finance with debt, what's the implication? All right. For example, you can finance this premium of 480 million naira by cash. So the premium can be financed with cash, but it may result in dilution of earnings per share and reduce dividend payout ratio. What do you mean by dilutions of earnings per share? The premium will be paid out of the profit after tax. So because you are removing the 480 from the profit after tax, and your denominator, which is number of shares, still remain the same. Therefore, your earnings per share is going to reduce. That means you are diluting the earnings per share. So anytime you pay premium or you pay cash from the profit after tax, your earnings per shares will reduce. That's the implication. Then the second one is debt. Of course, even though debt is a cheaper source of financing because of tax benefits, all right, because of tax benefits. But if you finance with debt, it will result to dilution of ownership, and it also increase the gearing level of the organization of the company. So there is no how you are going to finance with debt that will not result to dilution of ownership, because if the company fails to pay the debt, then they can take over the ownership, or the ownership structure of the company may change as a result of that. And that's why, we usually say, okay, when the company is financed with 51% of debt, for example, we say the company is highly geared, so that's what we are saying here. If the company is unable to pay the debt, then the ownership structure may be diluted, and then it will increase the debt equity proportion. Okay, that's the implication. Then the last one is share exchange. You can issue additional shares. So the financing option through share exchange will not affect gearing level, of course, because you are not taking additional debt, but it is more expensive and will result to dilution of earnings per share and shareholders proportionate holdings. Again, when you issue additional shares, remember, when you say earnings per share is equal to profit after tax divided by number of ordinary shares. So if you issue additional shares, let's say, for example, currently the profit after tax is 1,000 and number of shares is 200. That means earnings per share currently is 5 naira. So if you now issue additional shares, let's say you issue additional 100 shares, therefore your new earnings per share will then be equal to, your profit after tax remain the same as 1,000, but you have issued additional shares, which is 200 plus, let's say you issue additional 100 shares. So this will then be equal to 1,000 divided by 300. So this will give us 3 naira, 33 naira, 33 kobo, whatever. So you can see our earnings per shares has reduced from 5 naira to 3 naira, 33 kobo. So that's what we mean by dilutions of earnings per share. When you issue additional shares, the base will increase while your profit after tax still remain the same. And then the shareholders' proportionate holding will also reduce. Let's say, for example, as a shareholder, let's say, for example, I have 10% shares in this company. Let's say my 10% shares, okay, 10% holdings in this company is equal to 100 units of the shares. I have 100 units of the shares. So which give me, out of this 1,000, out of the 1,000 original shares, out of this 1,000, okay, let's say the number of shares is 200. Let's make it 200. Don't let us go to 1,000. All right. So out of the 200 shares, I have 10% of that, which is 20 units. Okay. So I have 20 units of shares in this company and my holdings is 10%, which means that whatever the profits that the company wants to share to the shareholders, I will get 10% of it. Now that we have issued additional shares. So my own shares is 20%. Sorry, it's 10%. So 20 shares over 200 shares. That's what gave me 10% holdings. Now that additional 100 shares had been issued, so I cannot have 10% holdings again. My holdings will reduce. How? Let me show you. So in this case, my new proportionate holding will then be equal to, all right. So I think my shares still remain as 20 units. So this will be 20 shares divided by additional shares of 100 has been issued divided by 300. So that means I only have 6%. Okay, my proportionate holding has reduced from 10% to 6%. So this is what we are saying, that when you issue share exchange for the purpose of financing M&A transaction, it will result to dilution of earnings per share and then shareholders' proportionate holdings. Okay, so to dilute the shareholders' proportionate holdings. So this is the answer to number C of the question. I think you mentioned number B also. No, we did number B now. We did number B of the question. Minister of Finance, can you
We didn't
confirm that?
we didn't do it.
I
Already did.
thought only the hay.
Yes, sir.
Okay. That's why I even started with the C. I thought we did B. So in the B part of the question, the examiner is asking you, in the question, you are told that the company has capacity. Look at this. This is where we have the issue for the B. So you are told in the question that Eldorado, in this case, is EP. EPPSC has offered to acquire BOPSC through a mix. I've changed the name to Eldorado and Rascana instead of EP and BO. So, yes, the EPPSC has offered to acquire BOPSC through a mix offer of one of his share, that is 1/2, one of his two shares, plus a cash payment, such that a 30% premium is paid for the acquisition. So if EP acquire 50%, that is 1/2 of shares of a BO, the company will only pay premium of 30%. The company will pay only premium of 30%. The shareholders of BOPSC feels that a 50% premium will be more acceptable. EPPSC has sufficient cash reserve if the premium is 30%, but not if it is 50%. So there's a misalignment here. So the management of EPPSC has capacity to pay only 30% premium, but the shareholders of BO is asking for 50%. So examiner is now asking you in the B part of the requirement that you should estimate the impact on EPPSC equity holders if premium paid is increased to 50% from 30%. So in this case, what are you supposed to do? You are supposed to pay a premium of 20% on the value of BO. Value of BO, we calculated to 2,400, that is 2.4 billion naira. That's the value of BO. Now, you want to pay a premium on that. It's supposed to be, you only have capacity to pay 30%, but the shareholders of BO is asking for 50%. So examiner is now asking you, what will be the impact on the shareholders of EPPSC? The impact will be that if you pay beyond your capacity, it will result to loss. So because you are going extra mile, so you are going out of your capacity to pay that additional premium. Therefore, the difference of 20% is a loss. That's a premium loss. So you then calculate 20% on 2,400. So that will give us 480 million. So that's then because examiner mentioned the impact on shareholders. So therefore, you need to calculate to per share. You need to calculate per share. So what is the loss per share? How do you determine the loss? You have calculated loss to be 480 million. Then how do you determine loss per share? To get loss per share, it will be the total premium loss divided by post-acquisition number of shares. Post-acquisition number of shares. So the number of shares of the number of shares of EP is 210 million. We are told that EP will acquire one of two shares in BO, that is 50% in BO, and the shares of BO is 200 million. So 50% of 200 million is 200. It's 100 million. Therefore, 100 million plus 210 million, that will give us post-acquisition market value, post-acquisition number of shares of 310 million. You then divide the premium of 480 by 310. So it will give you loss per share. Let me show you what I've done here. All right. So this is what I'm saying. This is the solution to that number B. The equity holders will lose 480 million naira or 1 naira 55 kobo. If you like, you can do it in percentage per share if premium increased from 30% to 50%, as shown in the calculation above. Okay, the current value of BO is 2.4 billion. Increase in premium is 20% because you only have capacity to pay 30%, but you are asked to pay 50%. So that means you are paying extra 20%. So that 20% of 2.4 billion will give us 480 million. So because examiner says we should calculate the impact on the shareholders, therefore I need to calculate value per share, loss per share, because as a shareholder, I want to know what will be, how much am I losing as a shareholder. Let's say, for example, I have 1,000 shares in this company. So I need to calculate value per share, loss per share. Once I have the loss per share, I will multiply with the 1,000 shares that I have in the company. It will give me the total amount that I'm going to lose as a shareholder. All right. So anytime they mention shareholder, you need to your calculation should be to per shares. All right. So we have calculated the total value, the total premium loss to be 480 million. So you need to calculate value per share. To get the value per share, the loss per share, first thing first, you need to determine the post-acquisition, the loss per share. Loss per share will be equal to the premium, total premium loss. Total premium loss divided by post-acquisition number of shares. So we know the premium already to be 480 million. The post-acquisition number of shares, we don't know it. However, the post-acquisition number of shares is the number of shares of EP, for example, plus the number of shares issued to BO. So this guy here, number of shares of EP is 210 million shares. Number of shares issued to BO is 1/2 of the total shares of BO, which is 200 million. This will give us 100. So in this case, our post-acquisition number of shares will be 200 plus 100, which is 300 million shares. So you then divide 480 by, so that's what you have here. That's all you have here. So which is 1.55. So that's how we got the 1.55 here. So if you like, if you want to determine the percentage loss in value per share, all right? So value per share in percentage. So the share price of EP is 29 naira. So with a loss of 1.55 kobo, so that will give us 5.34%. So that's what we have done. Sorry, I thought I did it, not knowing that time could not allow us last time. Okay, so let me know if you have any additional question for me so that we can close the class. I've taken additional time of your, so yes. In that case, in the absence of no further questions, let's call it a day. We have one more class to go. By the grace of God, next week, when we meet, we are going to solve additional 2 questions, and that will be all. I think this is the 4th or 5th. This is the 5th question or 6th that we are solving. So we will have more next week by the grace of God. Like I said, if there's no further question, I want to say thank you for your patience and for reminding me too on the B and C part of the last question we solved last week. I want to say good night, everyone. We meet again by the grace of God next week. Bye-bye.
Good night, sir.
Thank you, sir.
Yeah, good
Good
night.
night,
You're
sir.
welcome. Yeah, good night.